How do you save tens of thousands of dollars in taxes when selling your home? Now, taxes are probably the least thrilling topic that I could be talking about here on my channel, but there is a very important exclusion that is available to eligible homeowners that we're going to talk about in today's video. But before we get into it, I have two important disclaimers. The first is I am not a tax professional. I'm not a CPA. I'm not a financial guru. I am just a humble real estate agent. Sorry for that one. But I have sold my own properties before, so I am familiar with the capital gains exclusion, and that's what we're going to be talking about today. The other disclaimer is that selling a property is not always the right decision. If you are deciding to sell a property based solely on your ability to exclude some of the gain, some of the profit, if you will, from the tax man, I would probably hit the pause button and rethink if selling is the right decision to begin with. Remember, we never want the tax tail to wag the dog. More on that later. Whoa, did a realtor really just tell me that maybe I shouldn't sell my home? What's he up to? What's his angle? Yes, you did hear that correctly, and no, there is no angle. I'm just pretty lousy at BSing people. Before we move on, just allow me one tangent. Some of my wealthiest clients are heavily invested in real estate, specifically in rentals. I've asked them before, what is their biggest regret in business? And without fail, the answer is always some variation of, I should have never sold that property. I should have kept everything I ever bought and just held it indefinitely. So interpret that as you will. Okay, so those are my disclaimers. What is a capital gain? So without getting too wonky, you earn a capital gain when you sell an investment or an asset for a profit. So for example, you bought your home 10 years ago for $500,000. You sold it today for $1 million. Now that difference there, that $500,000 difference, that is your capital gain. Now, there are things that you can do to shrink that $500,000 capital gain. I'm sorry to interrupt this important message, but I'm here to remind you that this guy is not a CPA. Please consult your CPA, your accountant, and don't listen to everything you hear on the internet. Okay, back to the program. For example, if you paid real estate agents $50,000 in commissions to help you sell the home, you can reduce that from your total capital gain, reducing it to $450,000. What's that? You spend $100,000 on capital improvements? Well, guess what? You can further reduce that gain to $350,000. Yahtzee! Let's talk about how you can qualify for the capital gains exclusion when selling your home. Here's a quick screenshot directly from the IRS website. The IRS has two tests that you need to pass in order to qualify. The first one is the ownership test. Have you owned that property for 2 of the last 5 years? If yes, great. The next test is the use test. Have you used that property as your primary residence for 2 of the last 5 years? Again, if the answer is yes, fantastic. You're on your way to being able to exclude a capital gain when you sell that home. Let's have some fun. So a woman rents a property for a 1-year term. At the end of that 1-year term, she negotiates with her landlord to purchase the property. She is now the owner and no longer the renter. After her first year of ownership, she calls Grant Lightfist to say, hey, can you help me sell my home? Oh, and by the way, will I be eligible for a capital gains exclusion? Well, my answer to that question is going to be, you did pass the use test. You were using that property as your primary residence for 2 of the last 5 years, but you weren't the owner, so you're going to fail the ownership test. You were only owning it for that 2nd year that you were there. Unfortunately, in this specific scenario, she is not going to be eligible for the capital gains exclusion. Moving along, assuming you have a gain from the sale of your home and you pass the ownership and the use test, what happens next? You can exclude up to $250,000 in gains if you're filing your taxes as a single person, and up to $500,000 in gains can be excluded if you're filing your taxes as married. You and your wife bought your home for $500K, you sell it today for $1 million, you can exclude that $500,000 profit from any federal capital gains taxes. Wow. That's a great feeling, and enjoy it while it lasts because, well, surprise, the state of California does not offer any type of exclusion like this. Yep, California will be taxing your $500,000 profit, and they will be taxing it as ordinary income. I want to address one common question or common scenario that people will throw at me when I'm explaining capital gains, and it typically goes something like this. We bought the home for $500,000, we're selling it for $1,001,001. If you are married filing jointly, that first $500,000 in gains will be safe from the IRS. That last dollar is going to be subject to federal capital gains taxes. Based on your income, you're going to pay either 0%, 15%, or 20% in capital gains taxes just on that last dollar. Check out this chart from fidelity.com. This details the capital gains rates for 2024. But keep in mind, in this specific scenario, you're likely going to reduce that $501,000 gain, right? So if you hired agents, you paid them 50 grand, you're going to be reducing it. Let's say you put a new roof on the property. That will be a capital expense that will further reduce your gain. So it's actually very unlikely in this specific scenario that you end up paying any federal capital gains tax. taxes. The broken record says, please talk to your accountant, talk to your financial person, whoever your CPA is. And when you do, ask them specifically about qualified deductions and qualified capital improvements. Circling back to the point that I made earlier about not letting the tax tail wag the dog. Now, this scenario has happened several times before with some of my past clients, and that's why I'm bringing it up now in hopes that it does actually happen to you too. So the scenario is typically something like this. I sell my client their first home or their first condo. It might not even be their first property, but their business begins to take off, or they begin to rapidly get promotions at work. The point is, their income also begins to rapidly rise, and they soon start to think, hey, we want to begin trading up into our next property. The conventional wisdom is to sell your current property and roll that equity into the replacement property. And why not? You get to exclude possibly, several $100,000 from capital gains taxes. But if you're in a position to keep the current property while also trading up into the replacement one, consider keeping the current property as a rental. And if you don't have the cash on hand in order to be able to pull that off, consider doing a cash out refi. It's likely that your current property has increased in value over the last several years, enabling you to do so. Obviously, you'd want to make sure that whatever you can rent that current property for covers all of your monthly expenses, your principal, your interest, taxes, insurance, homeowners association fees, monthly maintenance, vacancy, etc. And just a fun fact about cash out refis, that's a loan and you're not taxed on those dollars that you receive from that refinance. Whatever you decide, make sure you're consulting qualified professionals. Take the time to ask questions, gather information, and make an informed decision for you and for your family. If you have questions about capital gains taxes or even just the real estate market here in Ventura County, all of my contact information is down below in the description. Thank you so much for watching, and we'll see you on the next video.